Hi everyone, I'm Karunya Rao, and in Ideas for Profit we talk about a niche player in the auto component segment, that is GNA Axles. It has a strong brand, long-term relationship with clients and healthy financials. With leadership position in the domestic market and significant presence in leading economies, coupled with positive industry outlook and reasonable valuations, the company merits investors' attention. As a part of our Discovery series, we had identified GNA Axles as one of the ideas that can be part of a long-term portfolio. The stock price has run up 46% since then, and as compared to 20% rise in Midcap index, it has been a clear outperformer. And the surge in price has been corroborated by strong financial performance during Q4 FY21. Riding on the strong demand recovery in the CV segment and continued growth in demand for tractors, GNA posted strong numbers during Q4. It saw a year-on-year growth of 71.6% in sales, driven by 106% growth in domestic market and 83% jump in exports. There's also low base effect at play here, of course, from last year. The export revenue grew on the back of recovery in North American, South American and European truck markets, and domestic revenue grew on the back of sharp uptick in the domestic tractor demand during March quarter. There was significant operating leverage which helped the company post an EBITDA margin expansion of 515 basis points year on year. The expansion is, of course, despite a significant rise in raw material costs. GNA generates close to 30% of its revenue from domestic CV and tractor industries, and hence its performance is directly correlated to the demand scenario in both of these segments. Though the severe second wave of COVID-19 has dented the near-term demand outlook, the outlook for medium to long term is quite promising. The CV sector is expected to do well once the lockdown in various states is lifted and economy starts normalizing. Also, do remember that the budget had promised a huge increase in investment to revive growth, which is expected to boost the CV demand further. There's also the scrappage policy, which would be a key driver for the pickup in volumes for CVs. Demand in the tractor segment is also very healthy on the back of higher crop production, good crop prices, sufficient water, easy availability of finance, and of course there's prediction of a normal monsoon as well, which augurs well for demand. GNA supplies its products mainly to Meritor in the US, Europe, China, Australia and Brazil, and Dana in the US and Mexico as well as Brazil, and generates more than 70% of its export revenue from these customers. According to America's Commercial Transportation Research, also known as ACT, there's been a significant pickup in Class 8 truck demand in North America, with net orders registering a strong growth. In fact, the company's Q4 numbers indicate a sharp recovery in exports markets as well. And as per them, truck volumes in the US are likely to witness a 4.9% growth next year, and then grow at 3.2% every year on an average till 2026. Overall, the management is quite optimistic about the export market outlook. As I said, GNA operates in a niche segment of the auto ancillary space and is the leading manufacturer of rear axle shafts, spindles and spline shafts, which find applications essentially in light and heavy commercial vehicles both, and also off-highway vehicles. Now, due to this niche segment, it has limited competition in the same product range it operates in, which has also led the company to continuously gain market share. It currently has domestic share of about 60 to 65%. In fact, the company also has a high share of wallet with international CV manufacturers. Upcoming disruption from EVs has the least impact on the products that GNA manufactures, as they are critical for the mobility of any type of vehicle. Now, talking about the key risks to watch. Any slowdown in recovery in the markets can affect the company's financials. Long duration of lockdowns in Europe could also impact the company. There's also some pressure seen on the rising raw material prices. If that continues, it may hamper the profitability. But in terms of valuation, the stock is trading at 12.2 times of FY23 projected earnings, which seem very, very reasonable at the current juncture.